Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth. And today I'm delighted to be joined by Peter Davies from our Chief Investment Office. Morning.
Morning, Jane.
Peter is the Head of Direct Fixed Income here at Canaccord Wealth and is normally based in our Jersey office. So he's flown over especially this morning to record the podcast. So welcome. So the first thing we ask for people on the Coffee Break podcast for the first time is, what is your coffee of choice?
It's a latte.
A latte.
Yeah, soft coffee.
So it is a bit soft coffee. Yeah. We're normally espressos and black Americanos here, although I'm on iced coffee this week because it is so hot. So Peter, as you know, each week on the podcast, what we try to do is cut through the noise, demystify what's happening in the markets, and then hopefully our listeners can feel more informed, more confident, and more in control of their financial future. So this week, with Andy Burnham's arrival on the national stage, it's prompted a bit of fresh discussion about the UK's fiscal outlook. But I actually thought the more interesting story is about the power of the bond markets rather than the politics themselves. So given you are our Head of Direct Fixed Income, I'd like to talk to you about that in a little bit more detail, if that's okay, and particularly the UK gilt market. So I'm asking, why do bond markets have so much power over governments, and what does this mean for investors? But before we get into that, could you just remind us what is direct fixed income investment? And also just a little snippet on what you do on a day-to-day basis, because you're new to the podcast and our listeners.
Sure. So a lot of our assets here at Canaccord are invested in third-party funds, and some of those are fixed income funds that invest in a wide array of fixed income assets. But for some investors, it's more suitable to go directly into bonds without going through the funds and invest directly into corporate bond markets, where they know their cash flows, they can control their investments more, and it's more suitable for investors with a larger amount of capital to invest.
And so day to day, you're looking for those direct corporate bonds to invest in on behalf of clients?
Yeah, exactly. Day to day, we run a corporate bond fund, we run direct corporate bond investments, and day to day, my job is to invest those and help other investment managers around the firm to invest their capital into fixed income assets as well.
Brilliant. Thank you. Well, grab your coffee, grab your latte, and let's have a little look into the UK gilts market and what's going on at the moment. Probably before we get into it, could you just give us a quick gilts 101 for listeners who might not know exactly what a gilt is?
Sure. Well, I actually used to work at the debt management office, who were responsible for issuing gilts.
Were you right there?
I was there
for the government?
There for 5 years for the government.
Whoa! You're poacher term gamekeeper, right?
Exactly. I've got a bit of insight into the gilt markets, and effectively they're a loan, a transferable loan to the UK government, where you have a set of cash flows like any other bond. It pays a coupon and it pays a fixed amount on maturity as well.
Right. So the coupon is the interest rate.
Coupon's the interest rate. The price is set by the market, so you know you're getting back. And the convention is to talk about getting back £100 at maturity. Yeah. So how much you buy that gilt for will determine your overall return over that period. And those maturities can extend out to as long as 50 years, and roughly a quarter of those gilts are also linked to inflation as well. So their returns are somewhat based on inflation.
So for listeners who don't necessarily spend their days watching the gilt market like you do, why do governments care so much about the bond markets?
Well, it's a large amount how they finance themselves, and although they control a lot of fiscal policy, they can control taxation, and they can control their spending theoretically. They can't control the price at which they can sell their debt. That affects the government in a lot of ways. It affects them in terms of how much interest they have to pay in their own debt. And a lot of it is rolled over every single year.
Constantly refinancing.
Exactly. Yeah. It also affects the members of the public too, in terms of a lot of what their day-to-day spending is affected by interest rates. Their mortgages are affected by longer-term interest rates. So it affects governments in
so it sort of ripples out across the whole economy. Yeah. Okay. So essentially, the government is issuing gilts to try and raise capital for projects, initiatives, activities that they want to do.
Initiatives, And the government has a wide array of things they spend the money on. Some of it are projects, some of it is day-to-day spending, and gilts just feed into that difference between what they can raise in taxes and what they have to spend.
Okay, got it. So the headlines are telling us that 30-year gilts have moved much higher again. The yield on those gilts has moved much higher in the last week or so. So what is the market telling us with that?
There's a number of factors affecting the longer end of the gilt market. Sometimes in the last week or two, it's actually been more international driven. US yields have gone up as well. European yields have gone up too. And some of that is just due to central banks and their stance on inflation. And a large part of it is also to do with confidence in the governments as well. So in the last week or so, some of that has been more to do with a bit of economic data and the US central bank. But in the past, and certainly in recent past, it's been a little bit to do with the UK fiscal policy and outlook.
Okay, so longer dated gilts, they're more sensitive to political risk, are they, than shorter dated gilts?
They definitely are. The shorter end of the gilt market is more closely tied to the central bank and the rates that central banks set. And the longer end of the gilt market is tied to the long-term outlook for the government. And it's also affected a little bit by the fact that there's a little bit more speculative investment at that longer end of the gilt curve.
Yeah. So why are investors demanding a higher gilt yield now, maybe than they were a year ago? What's changed in that period?
Yeah, there's a number of things there, but one of the main things I think is due, and it has been for a while, the political uncertainty as well, and the fiscal outlook. A lot of governments are highly indebted. And when they're highly indebted, it's more difficult to issue more debt, and it's a supply and demand issue. So if there's a lot more supply coming, because they have to roll over their debt, they have to raise money, supply of gilt, then yields go up. So, at the moment, I think certainly in the UK market, there's a certain amount of political uncertainty. I think we're going to have 5 prime ministers over the last 5 years, and nobody's quite sure about what that means for fiscal policy.
So it's a bit of a report card on how disciplined government fiscal policy is and future confidence.
It is, and it can be a very strong report card sometimes as well.
So have bond markets become more powerful then in recent times?
Yeah, they have. I mean, as debt has gone up, that cost, that amount of debt that they have to roll over becomes larger and larger.
Yeah.
Interest rates have also gone up, so the payments on that debt has become higher and higher. As with the UK, some of that debt is tied to inflation. As inflation goes up, their interest payments become higher. So the government becomes very sensitive, and the amount of interest we have to pay on gilts at the moment is over 100 billion a year. Wow. Bigger than a lot of departmental.
Hang on, £100 billion a year on interest.
On interest. Bigger than most departmental
not look
budgets.
Too bad. Wow, that's quite a lot, isn't it? So actually, the power of the bond markets is they can potentially stop governments implementing the projects that they would otherwise like to deliver.
Exactly. So I think it was famously illustrated back in the US in '93 when Bill Clinton tried to enact a policy of spending and spending on his programs, and the bond market sold off rapidly before he had to make a U-turn and come back in it. In the UK, it was recently evident with the Liz Truss government. Liz Truss is
we all remember that.
And funded spending plans, and UK gilts and sold off nearly 100 basis points in a few days. And forced them to do a U-turn.
Okay, interesting. So the other thing I wanted to ask you about was the term bond vigilantes, which I thought was something out of a spaghetti western, but apparently is not out of a spaghetti western. It seems to have come back into fashion. Did bond vigilantes go away, and have they come back? What are they? Who are they?
Well, they've always been around, but in reality, they're just rational bond investors. It was
rational bond investors. That's not quite sexy as saying bond vigilantes, is it? No,
it's not. I mean, the coin was termed in the early '80s with the Reagan administration, but since then, the term has come back in periods of volatile movements in the bond markets, with investors not wishing to hold government bonds when they see that the risks are too high, or there's a lot of supply coming in the market. Those yields move higher, and can often force governments to change their spending plans and change their fiscal policies.
As we were talking about before. So the bond vigilantes are really just sort of out there keeping an eye on the government spending for the rest of us, yeah?
Yeah, it's not a shadowy organisation.
No.
It's just it's a number of investors selling government bonds because they don't like the yield.
And this yield that's gone up in the UK gilts of late, is it just a UK issue, or is it global?
Yields have gone up everywhere, but it was especially acute in the UK. A few months ago when Andy Burnham announced his candidacy for the Bakerfield by-election, I think 30-year gilts hit their 30-year highs at around 5.85%. Since then, they've talked the market. He's managed to reassure markets somewhat, and they've come down since then. But it's not just a UK issue. It's everywhere, but it's just particularly pronounced in the UK at the moment.
So, are they giving him the benefit of the doubt? Is this a Burnham issue, or is it a UK fiscal future confidence issue?
It's a little bit of both.
Okay.
The UK growth is not particularly high at the moment. Growth outlook isn't high. The UK debt is high. UK interest payments are high. But he has managed to reassure markets, and the yields have come back down somewhat since he announced his candidacy.
Interesting. Thank you very much indeed. Thank you for your time. I think it's probably good for me to sum up what is in my Canaccord takeaway coffee cup today. So this week's story isn't really about Andy Burnham. It's about a reality every government faces. Whether it's borrowing to fund growth or defence or public services, the bond markets ultimately decide the price of that funding through the yields. And it's a reminder really that whoever occupies Downing Street, the bond market remains one of the most powerful forces in the UK economy. And governments can make all the promises they like, but investors ultimately decide how much those promises are going to cost them.
You summed it up nicely.
Thank you very much. And thank you for coming to see us. It's lovely to have you here. Thank you everyone for listening to the Canaccord Coffee Break podcast. We hope you've enjoyed it. Hope you've learned a little bit more about gilts. Don't forget to hit follow on your preferred podcast channel of choice and you will never miss an episode. And as always, we'd love to hear your thoughts. Drop us a line. The email address is coffeebreak@canaccord.com. And I am sure Peter will answer any other gilt questions you may have if you want to drop us a line there. Thank you again.
Thanks very much, Shane.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.